What's up, Gould Miners? Today, we welcome Jered Sturm to the program. Jered is the CEO of SNS Capital, which currently owns and manages over 1,400 multifamily units in Cincinnati, Ohio. Jered has managed to build an incredibly successful group over the last decade and a half. And in this episode, we dive into the lessons that he's learned and the principles that he's developed and deployed to grow a successful multifamily venture. We start off the episode with Jered discussing his early days in the single family sector and how him and his brother eventually decided to pivot into multifamily and why they made that decision. Later on in the episode, we discuss some of the challenges that are inherent in today's market and how Jered and SNS have evolved their methodologies on how to add value to properties. This is an especially relevant conversation given how much of an impact today's inflationary environment has had on expenses. And then finally, we conclude the episode with Jered discussing some of the key performance indicators that they track at the property level to ensure that they are hitting their metrics and why it's so important for any LP investor to understand what the KPIs are before they invest. Jered is by far one of the most operationally competent operators that I've had on this program, really knows his stuff, and clearly demonstrates his knowledge and the value that he brings to his investors on this episode. So without further ado, everyone, let's welcome to the show, Jered Sturm.
The Gould Mine Podcast.
Jered, welcome to the Gould Mine.
Danny, thanks for having me. I'm looking forward to the conversation today.
Yeah, it's interesting because I was, doing a little bit of research on you before, and I've heard you on a couple of other shows, and you started in the single family space, and then you made the move to multifamily. Walk me through that transition, because it's something that I think a lot of people think about doing that are in the investment space, but a lot of people think and don't actually do it. So, what caused you? Like, what was that impetus, and what was that driving force behind you actually making the move?
Yeah, so I mean, to give some context, I've been in real estate investment full time for 6 years now, and I would say the first 5 or 6 were focused on single families or very small multifamilies.
Yep.
And that was a function of capital restraints. So I wasn't raising money from investors, just myself and my brother buying distressed assets with our own capital. And so we couldn't be out there at the time buying very large assets. But what was the impetus to switch to larger multifamily is we just always had a desire for increased efficiency. And so every time when we went from a single family to a duplex, it was like we could sense that like, well, that was easier because we just did 2 of the same thing. And then when we bought a fourplex,
right,
it was like, that was nice because we didn't have to recreate that. And then apply the same rule times 100, right? And just
right.
economies of scale, the efficiency, and really what we have built a reputation on is a core competency of operational excellence. And so that plays into just being able to build systems and processes. It's really hard to do that in the single family space, much easier to do in the large multifamily space.
How would you say that your early journey kind of helped shape your operational capacities, right? Like, did you learn a lot from that, or do you feel like, hey, the multifamily space was just totally different ballgame?
No, it's there's so much overlap, and my story is very much like a grassroots kind of organic growth story, where I actually started before I started buying in 2008. Prior to that, I was a maintenance technician for another landlord, so I was the guy, turning apartments, maintaining occupied units, plunging toilets, doing set outs, doing turnovers, and then use skill set to do to start a renovation construction company with my brother, where we were doing like higher end kitchens and bathrooms and additions for homeowners, and then shifted into buying distressed real estate and using our skill set in the trades to renovate, improve them, value add. And really our strategy hasn't changed all that much. We buy distressed assets, we force appreciation through better operations and some construction component, and then we strip that equity through some kind of debt restructure. That's what we did in the single families, and that's what we do in the large multis. And so the transition and all the lessons learned were very applicable. We actually just find it a little bit easier in the large stuff.
Aside from economies of scale, what would you say are the main differentiators, right? Like, and the reason I'm asking this is because I'm assuming that there's people in the audience right now who are thinking about making the transition from single family investing to multifamily investing, but they haven't decided, like something's holding them back. So what would you say, aside from economies of scale, what are the other main reasons that you find it easier or why you've found like your niche in multifamily and why you've kind of like gravitated towards that? Because there's some people I think that perhaps they think that that's the case, but they don't know. Right. And so like what reassurances or what reassurances can you give the audience that that's like actually like the right move?
Well, I can't say that it is. It was for us, right? But wherever there's challenges, there's also that opportunity and that upside. So the reason big institutions have trouble buying single family homes is because they're challenging to operate one by one, but maybe your audience, maybe it's the right thing to do, right? Maybe they have a full-time job and all they need is 5 single family homes paid off with no debt, and that's their goal. That's not mine. But what I really wanted was to be able to build a business around my assets. So building the systems, processes, and procedures. And you have to imagine when we have 1,400 units today and we have 50 plus employees. And so when you're writing, standard operating procedures and you're trying to give guidance to a team on how to handle your process, if you have a house built in 1940 and another one built in 2000 and one on one side of town and one on the other, it's hard to build those standard operating procedures, train on them, and hold people accountable to them. Where if you have consistency, you can build a scalable business. And that's kind of, I think a lot of people think economies of scale, they think of like cost savings, but I think of it as scalability from a systems and processes and building an organization where you can delegate some of those responsibilities off. I can tell you, because I spent a lot of years buying single families, like it was really challenging, and we have since sold all of them. Really challenging to hold someone accountable to processes when the asset itself varies so much. So I hope I answered your question there.
Yeah, and so my assumption is that you're vertically integrated.
Correct.
With in-house management. Yeah.
Yes. So we do not manage other people's properties, but we manage all of our own, and we also, for everybody defines vertical integration different, but for us, we not only have our property management in-house, we have our construction management in-house. So when go and buy a 100-unit apartment community and renovate every apartment with $10,000 to $15,000, those are our W-2 employees, and we have full-time project managers that handle all that repositioning.
So putting yourself in the shoes of, say, like an average LP that's coming in, they want to invest into like a multifamily deal. How does one discern? How does an LP discern, in your opinion? How do they discern a group that has tight SOPs, like defined processes, really knows their stuff, and the guys that are kind of just winging it? Maybe it's not their first one, but it's their first couple, and they haven't really defined those processes yet. It's a lot of smoke and mirrors, right? It's a lot of sizzle, no steak. So how do you discern as an LP, between the real players and the pretenders?
Mm-hmm. Yeah, I think if someone's saying like, I'm a good operator, a question that I rarely get asked from LP investors that I think is low hanging fruit to answer your question is, tell me what KPIs do you track at an on-site level to make sure my financial returns get hit? Right. So like, I should know how quickly my maintenance techs are doing work orders, how many they're doing a day, and then what the resident survey satisfaction result is for my maintenance techs. I should have 3 KPIs for my leasing agents. I should have 3 KPIs for my property manager. And I can tell you all of those and tell them what the targets are. And if they don't line up to what the financial projections are conveying, then it's kind of like, wait, are you good at operations, or did you just create a pro forma? Right. And I think when you say you're good at operations, what that means is you're good at holding people accountable to the projections that you're putting in the financial statements. Yep. And so I think most LP investors, what we forget is we get attracted to real estate investment because we hear podcasts like this and you think financial returns, but so many people forget financial returns are supported by on-site operations, and on-site operations are supported by the people who work there. And the question is, how is the organization holding the people who work there accountable to those specific targets? So all you have to ask is, what KPIs are you tracking? What targets have you set on those? And then you can even ask, if you want to, you can ask historically, how have you performed on those? track record always comes up, right? Track record. And I think that's obviously important, but track record is looking in the rearview mirror. KPIs are looking out the windshield. So I think it's a great way for LPs to get a sense on like, do you actually have a handle on what's going on at your property?
Yeah. And honestly, I mean, just like even you saying that right now, I mean, I think that's a fantastic question, because it really, it brings a lot of stuff to the front of the conversation, right? It brings a lot of things up that maybe would have otherwise been completely missed, right? Like if they don't have an answer to that question,
yes,
or they kind of BS their way through it, I think you know the answer. Yeah, that's really interesting, man. So when did you decide to bring the management in-house? When did you decide to bring construction in-house? Was that right away? Why don't you walk me through that journey, right? Like you and your brother, you start off, eventually you make the transition into multifamily. Where were you at then? Where are you at now? And at what point did you kind of make those pivotal decisions to bring, those key like arms of the business in-house?
Yeah. So started in 2008. And for those who were investing around that time, it was like the depths of the financial crisis. And so me and my brother being in our early 20s, not having a W-2 job because we were full-time, and being at the depths of the financial crisis, there wasn't a lot of banks interested in lending to us. And so those first few years, it took 3 years to get 8 properties because we were having to buy all cash and renovate all cash, no financing. But so it was probably around year 5 and maybe 20 units under our belt that we were trying to make the decision of like, do we continue to manage these or do we outsource to a third party manager? And so we actually came up to the decision that like, we're going to focus on what we're good at, which is the trades and the construction side of the business. So from day one, we were doing that. And that was kind of our competitive advantage, is like we can go in, buy heavy distressed. And at the time, if you remember, like foreclosure market had tons of distress on the market. So we were able to find distress everywhere and improve the properties. But so what we did is around year 5, we said, oh, look, we're going to focus on what we're good at, which is construction. We're going to outsource the management. But instead of calling, third-party management companies corporate offices, what we did was we looked at on like Zillow or apartments.com for similar properties to what we owned in our portfolio. And we just reached out to those listings as if we were prospective tenants. And so we were like, we're just going to start at that angle. And then if they do a good job servicing their customer, then we'll go talk to the sales rep at the corporate office. Yeah. And the results were so bad that we never got comfortable with handing off our assets to a third-party management company. And we formed the rest is history, right? We've spent the last few, we've spent 16 years kind of learning and improving and building our systems around our properties and operating them really well because we never got comfortable handing off our assets to third party.
It's a really interesting way to do it. I mean, it makes perfect sense, right? Like you gotta make sure that they're, if they're not answering your calls as a prospective renter, that's bad, man. That's really bad.
Property, right?
What's crazy is that you saying that though, like doesn't surprise me at all. I mean, I in my life, I don't think I've ever, when I was leasing or when I was renting, like, I don't think I ever had a good experience, with management companies. So it's interesting that you say that. Now, have you ever run it? Because you obviously network with a lot of other operators in the same space. Have you ever met operators that have had successful relationships with third-party management companies?
Yes, but it's usually on like $50 million multifamily assets where the revenue is just more supportive of hiring a true professional management company. And the business strategy is usually a stabilized approach because value add is a labor intensive trying process of like, you got to push through some friction to get to that upside. And the money's just not there for the third party manager to be incentivized to do that. And so if you're going to buy a class $50 million deal that's 200 to 300 units and you can hire a third party manager, that could probably work out, but that's not what we do.
Yeah, no, that makes sense. So at a certain scale, you're saying that you're able to hire a grade A property manager that's going to be able to like actually hire out and like fill the roles with the right people instead of like hiring people that are going to work for like way less money, but are way less talented or skilled. I mean, that makes perfect sense to me. So coming back to the strategy, right? Like, let's talk a little bit about value add in today's market, because, I think value add was actually very, I don't say easy, right? But like, it was a lot. Well, I'll say it. Value add was pretty easy. Like from 2008, right? 2009 to 2021, right? And then all of a sudden, things got really tight really quickly. And of course, like even in 2020, right, there was some wonkiness there, but we had a really good run. And now things are a little bit different. So how has your buy box shifted over the last couple of years? And what are the things that you look for now that you maybe didn't look for earlier in the properties that you acquired to, like, obviously like reposition them?
Yeah. I mean, our value add strategy has always been the same. It's to find distress and improve it. And that distress for us usually comes in two forms. That's going to be construction or better management. And so it's usually like those two things or a combination of those two things. And so property management or construction, we're always focused on that. And your comment of value add was easy. I would say value received was very easy during that time, meaning like market appreciation was easy because rents were just climbing. But value add that you had to work for was like still the same thing that we're doing today. And so when I think about better operations, it might just be that like someone is getting sloppy and their expense ratio is 60% when we know we can run it at 40% expense ratio. And then, construction might be that the property was built in the 80s or 90s and has original finishes and we need to upgrade those. And, that has never been easy at any time because it takes the logistics and the infrastructure to be able to go in and do all those renovations. But what is as like the low hanging fruit of like, just buy it and the rents will go up, has gone away. Like that was the wind at our back and we certainly benefited from that, but we benefited from that in addition to our efforts in the value add.
Yeah.
But what we've become really good at because of our on-site background and our operational expertise is finding opportunities between the lines. What I mean by that is like anyone can look at an income statement and be like, those rents are $900 and they should be $1,100. Like that's not hard. And unfortunately, like everybody pays for that, right? Like if you see a property that's the rents are $900, it can be $1,100. Most of that is built into the price that people are paying for it. But when you can find opportunities to increase expenses or increase income or decrease expenses that don't even exist on the income statement, that's where I see value add today. Is like it's all the little things added up. And I can give you a specific example if you'd like. That kind of
that'd be great.
So my background in construction, we bought a 72 unit building, and the building was built in the 60s. It ran on some very inefficient giant boilers. That anyone that was looking at the property to buy it, we're kind of like, this is going to be a nightmare.
Yep.
But not to get too far into the weeds, but each individual unit had its own air handler that hot water from the boiler ran up from the common area and poured over that air handler coil, and then a fan blew air across the coil to then run through the ductwork to heat the apartment. So with our background in construction, we looked at that and we were like, all the infrastructure is already there. All we have to do is put an individual hot water heater in each unit, and basically clip the pipes where they used to attach to the boiler and tie them into their own individual hot water heater. And then that now energy cost to heat the apartment is now on the electric meter, which is individually metered rather than the landlord. And it cost us about, $800 per unit to make that switch because it wasn't radiant baseboard heat. It was forced air heat using a boiler. And so that conversion is like, that wasn't on the income statement. There was nothing there to show us that could be done other than our experience in the trades and touring the property and seeing like, we can knock out this $100,000 gas bill with $800 per unit invested. And so that for us is like, that's where the most impactful value add is because it's not built into the price because the owner missed.
Yeah. And I mean, you recapture that at like a 5 cap, right? And you're at what, $2 million?
Yeah, I mean, it's not a 5 cap property. It's more like a 7.
Okay.
Yeah, so call it like a 15x on the, NOI reduction. Yeah.
Yeah. Okay. Well,
So,
I mean, that's still fantastic.
yeah. I mean, and those are the types of areas that it doesn't get built into the price, even if it's a fully marketed deal. And so,
Sure.
Most people touring that property missed that. They in their underwriting, they just plugged in $100,000 for that gas bill, and it's just like, it is what it is. We're never getting it off the boiler. And it's like, no, this is going to be an easy conversion. So that's one of many examples, but usually it's even smaller impacts than that, where we say like, you're overspending in your, snow removal, you're overspending in your landscaping, and for whatever opportunity we have to then drive down those expenses or potentially increase the income, the little drops add up. And that's really where value add is today.
Yeah, it's really interesting. And minimizing or reducing expenses, I think is really, I think it's like an underappreciated, but like very critical part of repositioning, especially in today's market. I'm on the hotel side of things primarily. I do a lot of stuff with hotels, and expenses have just gone through the roof, and so I'm wondering, in the multifamily space, I'm assuming, that you guys are seeing the same thing, expenses going up, and so, obviously you're finding things that you can bring down, but how are you fighting, the just like overall impact of inflation when it comes to, the overhead required to run, these larger scale apartment buildings? Yeah, I mean, the 3 accounts that come to mind that are like just super challenging in the past few years is property taxes, property insurance, and payroll. The other accounts that we've been able to combat pretty well are like, call it like maintenance materials or CapEx, and like, our scale and our background allows us to push back against those. But what we've been able to accomplish, we can hold our expense ratio for us usually around like 43%, is kind of what we see across our portfolio. And it's because, yes, we experience the drastic increases in property insurance and property taxes and payroll, but we've been able to offset that through improved rents or some other source of income that we're getting creative with, whether it's like revenue sharing accounts through cable and internet, water reimbursement setups, things like that. So we have been successful in making sure our income and our expenses are increasing at the same pace to get us back down to an expense ratio of about 43%. But there's just some accounts where you just kind of take it on the chin and look for other areas to offset it. How often is it that you come across a property where, I'm sure this has happened before, where they're running it, and deep down in your heart of hearts, you're like, we could easily recapture, 10-15% margin on this property, right? Just with doing our things. How often is it that you find those properties and not be able to hit your desired, meaning like you thought you would be able to do it, but like for whatever reason, like that property was just different? Like, has that ever happened to you guys? And what was that experience like? Yeah, I mean, things go wrong all the time, and you do your best to underwrite accurately. What I'm super proud of our team is like, when things go wrong, when I say we're really good at operations, really what that means is we're really good at rolling with the punches, and when things go wrong, making adjustments. And so we might get it wrong on CapEx, but the question is like, with our operational control, how are we then adjusting? Rather than just saying like, sorry, we got it wrong. And at the end of the day, we have been very good at getting back to our projected returns. And so, as a general partner and syndicator, I'm super proud that, we've never paused distributions. We've rarely fallen short of our projections. And a lot of that comes through the hard work of like, hey, we got that wrong, but what else can we do, right? Where else can we find opportunity? And we're just constantly fighting that battle over and over every day as things move around on us, right? You buy a property and 5 years later, you think the business plan will go all to your original projections. You're crazy. Like they move around on you constantly. And that's part of what LP partners should be looking for, is someone who's going to be there rolling with those punches, fighting the fight, and making sure you get back on track when something goes wrong. Yeah, it's not about who can operate when times are good, right? It's about who can weather the storm when times are bad, and that, I think that goes back to the it's like that age old saying, right? Bet on the jockey, not the horse.
Mm-hmm.
All these deals, they all pretty much look the same, and so how do you disseminate the good ones from the bad ones? And it's really, it has something to do with the deal at the end of the day. It has everything to do with the operator. Plus, if you're picking a good operator, here's what people don't like I think fail to remember, right? If you pick a really great operator, the chances of you getting into a good deal is like significantly higher, right? Because like good operators are better, like have better discernment and usually pick better deals, right? And so it all usually just falls in line, right? So it's interesting, how it always seems to come back to that. It always seems to come back to that. Now, speaking of the expenses, we were man, I lost my train of thought. When you were talking, I was like, I had this question in my head. I was like, man.
Well, I was thinking of something, so I'll run with it and tell me if it comes back to you. But one area that we are just really, because of our background in the trades, we're really focused on being efficient on is our repositioning costs, specifically the CapEx for like renovating and improving the properties. And so all of that's in-house for us. And, one of the KPIs we track is from the time that our turnover team, our team of 4 guys that go in and do, $10,000 to $15,000 in renovations, kitchens, bathrooms, flooring, all of that, we average 2.5 days, right? So they go in, gut, put it all back. We average 2.5 days. We do about 40 units a month, every month. And talking about offsetting some of those inflationary expenses like property insurance, property taxes, payroll, one way you can do it is become more efficient with how you use that payroll. And so we have gotten it down to such a science because all of our units are pretty similar, is like when our project managers order the materials, they show up on the day that our turnover team shows up to begin demo. And we even have in the scope of work of like, when you unload the pallet from the front of the building into the apartment, what corner of the room should you stack that flooring so you don't have to move it twice, right? So it's like, yes, payroll expense is increasing, but how do you become more efficient with your payroll expense so then the bottom line ends up being the same? Sure. And a story that everybody loves is like, we have gotten it down to where even my brother, who is our COO, and he went on site to watch some of our turn teams work, and he's looking around and he's like, yeah, you guys are doing a good job. But then he sees on the kitchen counter in one of these apartments that's being renovated, some Red Bull cans and some Gatorade bottles. And he's like, hey, where do you guys get those? And they're like, oh, we just drive up around the corner to the gas station. So like in his mind, he's thinking like, okay, that's 10 minutes, 15 minutes. The guy who left probably has the material or tool that everybody else needs. So everybody's waiting. So like, what's the efficiency lost? So now when our project managers order the pallet of materials from our supplier, they add a pack of Gatorade and a pack of Red Bull. That helps with our employee turnover because they feel really well taken care of. We're buying the drinks they like. They're well caffeinated, so they're working faster. They don't leave the property, so we don't lose efficiency. And that's how we can, those small tweaks multiplied by hundreds of different occurrences is how we renovate full apartment renovations in 2.5 days, which then hits vacancy, which then trickles down into every other account that vacancy impacts. And so our bottom line significantly is better, potentially because of us buying some Gatorade.
Yeah, that's awesome, man. Well, it's interesting, right? Because it's like, I definitely think that there's the one thing that I'm hearing over and over again here, just based on what you have told me, is that you guys have a very like boots on the ground approach, right? Even though you've managed to scale to what now it's like 13. Is it 1,300 units, or are you more than that now?
We're right at 1,400 now.
1,400, yeah. So you've managed to scale to 1,400, but it's still a fairly boots on the ground approach, and that's those tiny hinges swing big doors, right? And so it's interesting that you've still managed to keep that. Why do you think that is, man? Like, how have you guys managed to keep like a more, I guess, active role despite having over 1,000 units? Because at some point, like it's got to feel a little overwhelming, right? So
I think part of it's because we've been so geographically focused. So we only buy in one market, Cincinnati, Ohio. And so having our team all close and having our properties all close, we can still be involved. I will say like we're far less involved, but the team can share their insights and work together, where if I bought one property in Michigan and one in, Chicago and one in Cincinnati, it's like, that's all out the door. All of the learned benefit that we have and the efficiency that we have, we share that across our portfolio. So I think that's a big part of it, because I know that the further away you get from home base, the more you lose that competitive advantage.
Would there ever be a scenario in which you would buy outside of Cincinnati, do you think?
We've kind of modeled it out, and my best guess is like no until probably about 2,500 to 3,000 units. Because the whole time as we're scaling, we are thinking about like, are these systems and processes scalable into other markets? And so we're looking for that, and how do we build those out appropriately to where they could translate? But I think we're learning that as we go, of like making sure that this process is not being built specifically just for Cincinnati.
So I'm gonna flip the script here a little bit, because I did remember. Now, we talked about those KPIs, right? So when someone asks you, what KPIs do you track? You rattled a bunch of things off, but I'm curious, like, specifically, what are the KPIs that you guys track at a property level that are going to, directly impact or like directly correlate to, whether or not we're hitting our pro forma or like hitting our desired numbers?
Well, I would say all of them should directly impact. That's a good KPI, is kind of like, if they're not impacting the bottom line, then they probably shouldn't be on the KPI list. And so I can work through kind of the on-site levels, but like starting at entry level, you have maintenance tech and leasing professional, right? That's our roles are called that. So a lot of our KPIs are broken down into speed, quality, quantity. And those are kind of like, they counterbalance each other, right? You could have a maintenance tech that fixes 500 work orders a day, but all he does is run around and put a piece of duct tape on it. So it's like, that's not good. So we want quantity and quality to kind of offset each other. And the way we track that for our maintenance team is speed is number of work orders per day. And so our target is 5 to 7. So we expect our maintenance techs to do 5 to 7. The quality is monitored by a resident survey that gets sent after every work order is completed. So it's a 1 to 5 Likert scale. And we tell our team, you need to average 4.5 or above on the residents' feedback of your quality.
Yeah.
And speed is the length of time the work order is open from when the resident submits it to when they complete that work order. And, I'm super proud of our team. It's one of our biggest strengths is our maintenance team, coming from my background and my brother's background. And we averaged, last month, we averaged 22 hours. So we used to track it in days, and we had to cut it down to hours, because across 1,400 units, we're talking about hundreds and hundreds of work orders. Our maintenance team averaged 22 hours from when the resident put it in to when it was completed. And if you don't think that impacts the bottom line, it absolutely does, because like our average resident length of stay is double the industry standards. What's the number one reason why residents move out? Is because they have unsatisfied maintenance issues. And so like, talk about, does the KPI impact the bottom line? Like absolutely it does, right?
Yeah.
You treat your customers well and you fix the problems that they have. It's not rocket science. It's just like decent customer service, but we do that really well. I'll give you the leasing professionals and let me know if you want any more, but leasing professionals is a sales role. So we track conversion rate. So we know the number of, in our system, it's called guest card. It's like inquiries. We know how many come in, and we want a 20% conversion rate to an application. So like a screened application needs to be 20% conversion rate. So we hold them accountable to that. Then the second KPI that our leasing team gets held accountable to is the number of days after the construction is finished to when the resident moves in. And a lot of their commission is based on this, right? So we're talking about vacancy. Vacancy is a normal KPI that people track, but vacancy, lots of different people are accountable for vacancy. So let me break that down. It's kind of like from the time the resident moves out to the time the construction starts, the leasing professional has no control over that. The project manager does. So the project manager is held accountable to that section from the time the construction starts to the time the construction finishes. Our turnover teams, they average 2.5 days. And then from the time the construction finishes to when the resident moves in, that's our leasing professional, and they actually get commissioned based on the number of days. So they're, as salespeople, they're trying to line up, like, as soon as that unit's ready to be moved into, we want you to start your lease on that day. They're very good at it. Actually, similar to our turn teams, they average 2.5 days. So our vacancy, and the reason why we can hold like a 98% occupancy rate is because, vacancy is how many turns you do and how fast you do them. We're really fast at our turns too. So those are some of the KPIs that we track at like the entry level on-site positions. And if you can hit those from a leasing professional's KPIs, you're going to really drive your occupancy up and drive your vacancy down. And then all those other turnover costs and vacant utilities and all these other accounts that are on the expense line items are going to be significantly impacted, and your NOI is going to benefit from it, and your property value is going to benefit from it. So one thing
that's awesome, man.
One thing I didn't mention though is like what we do is we also use AppFolio as our property management software, and it allows us to present all of those KPIs on a live feed, and we can show every person in the company's data. And so like our maintenance guys will all like compete, right? Like, so they can see where they're at on this scoreboard. And so, they are praised and awarded based on their speed at which they can do resident requests. And they like being at the top because we hire competitive people, and it's like friendly competition. But when you hire top performers and you show them where they're stacking up against their colleagues, it's like, I don't want to take 3 days to do resident requests. I'm going to get it faster. Then they reverse engineer and problem solve.
I love that. It's adding, what's interesting, right? Because usually that sort of competition is reserved like exclusively for sales team, which like leasing staff, I guess technically would constitute as a sales team, but like maintenance, gamifying the maintenance, it's a pretty awesome way to look at it. I think that's really, you're tapping into that, like, competitiveness, human nature, right? The competitiveness of humans and whatnot. That's really interesting, man. And by the way, like I have to ask, because you're some of the things that you're sharing today. I've talked to quite a few operators, and I don't know that we've ever gone this granular. And if we have, they certainly haven't been, I guess, as system oriented as you, at least in terms of like, our discussions. And so, are these things that you developed yourself, or have you like sought outside, like either business coaching or like, how did you develop these processes? Was it all trial and error? Kind of walk me, like the gamification of the sale of the maintenance staff, right? Like how did you kind of come up with all of these different things?
Yeah, most of it's trial and error. We haven't done like consulting or coaching. But you have to keep in mind, like with my story, it's very like I use the word like grassroots kind of organic growth. So I have been in their shoes, right? I've been the maintenance tech. I understand their role. And Danny, like you have to imagine, whether it's a maintenance tech, a leasing professional, property manager, or any organization outside of real estate, if you don't have a way of tracking someone's performance and telling who is a top performer and who is not, which unfortunately is like the norm for most on-site property management level positions. So like the norm for a maintenance tech, like when I was a maintenance tech, I was a very hard worker. I did a ton of work orders. I thought I did a good job, and I made the same exact amount of money as the guy that slept in the maintenance shop half the day and basically hid from his work. But we made the same amount of money, right? And so it was kind of
frustrating.
Like, and if you just knew how many work orders I did or how fast I did them, you would be willing to pay me more. And so I built a company that could acknowledge top performers. And what happened was, when you are back to that like hypothetical or that story of like, you have one maintenance tech who's sleeping in the shop and the other one who's busting his butt, they're making the same amount of money. And then they hear about an organization like ours, SNS, and they're like, oh, they track that, and they praise the top performers, and they pay really well because they can know who's producing the best output. Like, I'm going to be like, I'm just going over there. Right. And like, as our company has grown, built that reputation of like, this is where the top performers work. And yes, we hold very high standards, but we know how to track and actually like acknowledge when you meet those standards. Yeah. And from a recruiting standpoint, it's been really impactful. It took years to figure it out. And there were times in the beginning where we tried to do it and we didn't have a big enough staff. So like, I'm going back to the maintenance, I know we're like pounding away on this maintenance example, but we tried to roll that out probably for the first time like a decade ago, and we had 3 maintenance people, and having 3 and pinning them against each other felt like it was not effective. But when you have 15, it's like, it's not always that one guy on the bottom over and over and over feeling discouraged.
Sure.
And instead, what we see happening now is like you'll have someone who kind of stays at the top, and they turn around and kind of extend their hand and say like, let me show you how I did that. Right. You have people that are like in the middle that say like, I'm going to call that guy and be like, how in the heck are you hitting those numbers? And we try to create that camaraderie and that atmosphere where it's a friendly competition, not like, let me see how I can undercut this person.
I mean, it makes perfect sense to me. And, having run a sales organization myself, a lot of the things that you're talking about, it really resonate with me. And I think that there's a lot of truth to what you said. And the thing that really stuck out to me, and I hope what sticks out to the audience, is that your standards attract a higher caliber individual, right? A lot of people think, this company has standards that might be like a deterrent. And it's like, yeah, it deters the wrong people from showing up to begin with. And so, man, I love that. I think that's great. We're coming up close-ish to time. I had a couple more questions specifically about the Cincinnati market. What is it about the Cincinnati market that obviously you're from there, so it sounds like that's your backyard, but clearly you have thrived in it. You've built a very strong business in that market. And so I'm wondering, what are the fundamentals of the Cincinnati market that that you believe have created, a successful like multifamily business? I know I know other multifamily operators in Cincinnati. It seems like a market that's pretty ripe for that asset class. And so I'm wondering, what really drives that, and what are the fundamentals that kind of like that support that?
Yeah, no, I appreciate the question. And yes, I'm born and raised here, so I'm biased. And but it's funny because I've been buying here for 16 years, and feels like the first 12. Well, let me take a step back. Our investment philosophy is to produce consistent, predictable cash flow. That's what SNS likes to do. That's our target. And for the first 12 years of my career, call it 2008 to 2020, outside of Cincinnati, would look at Cincinnati and call it a stagnant market. Mm-hmm. And then from 2020 to current, we're called a stable market, and nothing has changed, right? Like, so the Midwest and Cincinnati just kind of chugs along. Nice rent growth, nice steady population growth. We don't have a lot of volatility in our rents. We don't have a lot of volatility in our cap rates. Our valuations kind of just plug along at like a 2 to 3% rent growth and valuation growth. And that consistency and that predictability is really what we're targeting. So it's a market that caters really well to our investment philosophy. But the only thing that changed during that time frame is like what the coastal markets and what the Sun Belt was doing. So like everyone who was really like loving all of that, like huge upswings in, Texas, Florida, and Georgia, were like, oh yeah, Cincinnati's stagnant. And then those start to come down while Cincinnati just keep chugging along. And they're like, that's a very stable market. And I'm like, yeah, we're doing the same thing we've been doing the whole time. But from economic fundamentals, we got about 2.2 million people, pretty diverse job base, multiple, I think 5 or 6 Fortune 500 companies headquartered here. I think every market's a little bit different, but when I look at nationally, there's one universal truth, which affordability is an issue. The Midwest and Cincinnati, while I wouldn't say we're immune from that problem, we're definitely not as sick from that problem as other markets. And I'll give you a specific number. Like our average rental rate is 17% of our average household income. And like the Sun Belt is going to be like 33%. And we know that's the very edge, which tells me like either it's not sustainable or there's no room to move up unless wages move up. Whereas where I look at Cincinnati, and it's like, that's a very sustainable number, and potentially room for growth. And as, younger generations, the biggest generation, millennial generation, starts to settle in and look for a place that they can, I never would say like Cincinnati's going to be the next, Phoenix or Austin or, it's not.
Sure.
Happening.
Yeah.
But if you're a person looking for a good quality of life in an affordable market, you can do that in Cincinnati. So like when the millennial generation ages out and wants to buy a home and raise a family, like it's financially feasible here. Whether we'll see a huge spike in population growth, I doubt it, but maybe a slight uptick in what we've already seen, which is like a 2% year-over-year growth.
Thank you for that, because that answered some of my questions. Now, on the flip side, from a like more micro level, like a community level, right? As an operator, you probably have some rules, right? So like there are some rules for pockets or neighborhoods or communities that we buy in, and pockets or neighborhoods and communities that we stay away from. What are those rules?
Yeah, so we will target like a median household income of $55,000 or more. It's kind of like the middle of the road for our market. So another way to translate that to the typical listener is like we are usually in like B class multifamily. Some people might call it B plus, but we do not buy like D class multifamily, and we don't buy A class multifamily. We kind of settled into that middle of the road. There's other more nuanced like neighborhood type comments of like there's this specific areas that might have like a political agenda or things like that we avoid. But I would say what we're really focused on is satisfying the median or average household renter.
Okay, that makes sense. So it sounds like one of the main things that you focus on is median household income for the particular areas that you're buying in. So if you see that the median household income is lower than your target, you're probably going to stay away from that deal.
Yeah, and we're also like looking at like we're in like the primary or secondary markets. We usually don't go out into tertiary markets. So we're looking for employer bases and length of commute to large employers and things like that, and employment diversity. But we're typically not buying way out into rural Ohio or anything like that. And so usually most of our acquisitions are going to check that box pretty easily.
Yeah, it makes a lot of sense. That's awesome. Dude, Jered, you have been you're just like dropping knowledge, and you're like a multifamily encyclopedia. So I really appreciate your time. This has been a lot of fun. Before we wrap up though, as is tradition here at the Gould Mine, it is your responsibility now to leave the audience with one final Gould nugget. Take it away.
Well, I think I said it somewhere in the podcast, but I'm going to bring it back up because I think it's worth shining a light on this Gould nugget. I think so many listeners seek out these podcasts and they hear about, my story of like, oh, I went from a maintenance tech to, $200 million in multifamily, like financial returns is why I'm here, right? To make money. And a lot of the listeners will like focus in on that. And I think what's so important, hopefully my story conveyed, is financial returns are supported by on-site operations. On-site operations are supported by the people who work there. And so you have to have the right people, and you have to know how to hold them accountable and give them the right processes. If you don't get those other things in place, the financial returns will not come. And I think we just so often jump those steps. And hopefully my story is just an illustration of like, you got to get those first things right. If those are the hard things, right? Like those are the hard things to figure out. You get them right, the financial returns will follow. But so often we're trying to skip that.
Who was it that said business is just systems and people?
I don't know, probably every businessman or woman.
Yeah. No, but it's very famous for, it's not Buffett, but it's someone like Buffett. It's like business is just systems and people. And it's true. Right. And that's exactly what you just said. Right. The systems and then the people that support it. It's easy to get sucked in by the numbers, right, man? Like it's so easy to get sucked into the numbers but the numbers are just, they don't tell the whole story, because the people are responsible for driving those numbers.
People mistakenly think I'm going to buy this asset and the asset is going to produce this for me. It's like, that's never been my experience, right? Like,
right.
It's like you have to go to work. And another way of wording that is you can buy the greatest investment opportunity ever and run it straight into the ground with the wrong operator, or you can take even a mediocre one and do really well with it with the right operator, which you said earlier in another wording. But like every seasoned real estate investor will tell you that is true. And that tells you that the financial returns are supported by the operations.
Right.
Like, basis matters. Yes, buying a deal at a good basis is a good idea. But like, you ultimately generate your value and your cash flow through how you run it.
I couldn't agree more. And yeah, man, I think that's a great little nugget there and some food for thought, regardless of whether or not you are, active investor in your man. I think that there's a lot of gold in there for the people who are active, but then also for the people who are passive, remembering that like the people who are responsible for your, like, there's more than just the numbers on the screen that you're looking at, right? Like what are the driving forces behind that? And I think it's something to really keep in mind when you're, before you stroke a check, right? Jered, this has been awesome, man. I really appreciate your time and who knows, maybe this won't be the last time that you're on the show. I would love to have you again. Yeah, no, I appreciate the opportunity to share a little bit about my story. Hopefully your audience took something away from it. Thank you again for the opportunity to do so. Absolutely. And by the way, all of Jered's information, how to contact him, how to get a hold of him, if you're interested in learning more about his investments or his investment opportunities, you can find the links in the show notes. Jered, it's been awesome, man. Yeah, Danny, thank you.